Market today seems like it's pretty strong. It's kind of basing above that big 4,200 level that we have been talking about for seems like ages now. But we're kind of basing above that, which is generally a good sign. But the options flow, as we're going to talk about and kind of dig into a little bit, the options flow is a little bit negative, actually, which is a bit surprising. Flip over to the Nasdaq, we can kind of check out the flow there as well. Nasdaq having a pretty good, solid, bullish day here, pausing at this big 1370 level, or excuse me, 13,700 level. 1370 would probably send some panic to people's trading accounts. So this is a big resistance area, and you can see oftentimes that there will be inflection points with some of the options flow. We'll kind of dig into this. I'm just trying to give another minute for some people to file in here. Hey, Mark, what's up, man? David. All right, so let's get started here today. Thank you, everyone, for taking the time out. I know it's the middle of the session, so we're going to keep this pretty quick here. And hopefully spend a few minutes after the initial presentation just to talk about what we're seeing in the market right now. So we'll kind of quickly flip through the initial presentation that describes what this HIRO indicator is, and then we will kind of use the HIRO indicator today to talk about what's going on in some stocks like GameStop, as well as obviously the Nasdaq and ES futures. So first we want to obviously welcome everybody. Again, thank you. This is for SpotGamma and Bookmap. They have been excellent partners here in helping develop this brand new indicator, and we're very excited about it because we think it's the first time that anything like this has ever been built and certainly made available for the general public. You know, I think there's probably some market making firms out there that have something kind of similar maybe, but we've never seen anything like this that's kind of available for us retail public and institutions, non-market making type institutions. Obviously, anything we talk about here today is not trading advice, right? Please do your own due diligence and do not trade on any of our recommendations or comments that may be made here on this talk. So first, a little bit about SpotGamma. For those who are not familiar with SpotGamma, we provide options analytics. And what we do by that is we find out where market making hedging flow is likely to pick up around what strikes that is large market making flows are likely to pick up. So we analyze the options market. We figure out where major risks are, pretending that we were actually market makers or dealers. And based on our models, we're able to figure out where flows, stock and futures flows, will come into the market as hedging. And that hedging can form support and resistance lines as the market approaches these key levels. So you'll notice here, this is a snapshot of the Bookmap trading system. There's a series of white lines here. These white boxes are our support and resistance lines, and the market will often respect these lines in a major way, and we're going to show some of that from the real-time data that you see at the end of this presentation. My name is Brent Kochuba. I have about 20 years of experience in equities and equity derivatives at Bank of America, Credit Suisse. I was at Wolverine, which is an options market maker, for a few years. And then I moved to the buy side, where I started seriously building out my own options models. And those models are much of what is available now at spotgamma.com. We also produce a twice written daily note that gives you some written analysis around everything that we're analyzing in the S&P and the Nasdaq. And then we have a product called the Equity Hub, which allows you to look at over 3,500 different single stocks like Tesla, Apple, GameStop, etc. So our core, the genesis of what we believe in markets, is that options hedging flows can drive stocks and futures. And as the options market has grown over the last several years and really several months, the impact of options flows, of hedging flows around options, I think has become ever more apparent. If you just think about, the first quarter of this year, GameStop, AMC, all these other kind of meme names were really moved, we think, by options. We've done a lot of in-depth research on our blog that shows the evidence for that and lays out our case. Now, as the options market grows, we think that the hedging flows obviously become more important. And one of the things that we have been trying to do for a while is find a great way to measure the intraday flows that take place. So SpotGamma looks at the open interest that is only made available once around midnight every night. And we take that options flow and we figure out where the big open interest positions are and the hedging flows around, obviously, those big open interest positions. But we didn't have a tool that showed us the intraday flows. What is happening in the middle of the day? How is the hedging pressure building up? And this is the tool that we've built here with Bookmap. One of the reasons that the options market making flow is also so interesting is we think it is the largest flow in the world. And what we mean by that is if you consider a large hedge fund or a pension fund, they may have one big order, and when they're finished that order, they're done trading for the day, right? So they may dominate that time frame in which they're executing, right? Maybe they have a VWAP order for the afternoon, or they just have a percentage of volume type algo order. And once that order is done, they're done, right? There's no more trading for them until down the road, and then determined to remove that trade. But the options market making flow is a continuous exercise. They constantly need to hedge and re-hedge every day, day in, day out, as stocks move up and down, as new flows come in, as options expire. It's hedging constantly all day, every day, and it is a lot of hedging flow. So we think that is why it is such a consistent, large force in the markets. I want to talk about the delta hedging basics. This is key to understanding the HIRO indicator. As many of you know, there's this concept of delta hedging, and what delta hedging is meant to do is isolate or remove the directional risk from an options trade. So if you think about the market makers, if everyone is out there buying calls in GameStop like they have been over the last several days, as a market maker, if I was a market maker, I would be short those calls. Now, that's not a great position to be in if GameStop continues to go higher. So the way I hedge myself would be to buy stock, as you can see in the table here. So if a retail trader or hedge fund or whoever it may be buys a call in GameStop or Tesla or the S&P 500, the market maker is short the call, right? And they would need to buy stock to hedge themselves. So as the stock goes up, they need to buy more stock. And then if the stock trades down, the market maker would sell off some of those shares, right? They would adjust their hedge. And that adjustment is called the gamma hedge. So you can see on this table here, I won't cover each individual point, but you can see that there's a very clear set of rules here, right? If someone buys a call, the dealer is going to buy stock to hedge. If someone buys a put, the dealer is going to sell stock to hedge. So these are the basics of the underlying flows of what the HIRO indicator is measuring in real time. Our view is that large options flows are hedged immediately, meaning if a giant trade comes to the market, say someone buys 10,000 at the money calls in the S&P and the SPX index, market makers need to hedge that immediately, right? That's a new trade. They have to get on top of that immediately. If someone in the retail public's buying a one lot of spiders, well, that's probably not going to get hedged, right? That's just going to be absorbed in their big, larger book, and they will adjust sort of as price moves around. But there are two times at least that we know of that are very important hedging points, and that is the market open, because obviously things have changed overnight, flows have shifted, options have expired or have been assigned, and then at the end of the day is the other important part. 4 o'clock, 4:15, the market close here in New York. Traders want to have their risk squared away. The market makers and dealers, just like any other trader, has risk sheets. And there are clearinghouses that have risk managers that are looking at these portfolios and saying, hey, you have way too much exposure here. What is going on? No trader wants that tap on the shoulder, right? So they're going to make sure that by 4 o'clock, their risk is hedged up for the day or for the night. And then the next day, they can kind of restart the hedging process. The last thing to note about the HIRO indicator and what's so interesting about it as we get into it is think about the options flows as a sentiment indicator. If you know that everybody is buying or selling calls or puts, right? That is very valuable information. And those flows can tell you something. If everybody's buying puts, that is a good piece of information if the market is selling off, right? You maybe don't want to try to buy a dip if everybody is buying puts as fast as they can. So these are the types of information that we can glean. And again, we'll show you another few examples here of that. So how did we set up the HIRO? Well, the HIRO takes the Oprah feed, which is called the Options Pricing Authority feed. It is the largest market data feed in the world, at least to my understanding. And it is a very difficult beast to try to manage. It requires a lot of servers, very advanced programming to kind of grep through all that information and figure out the flows that are taking place there, right? And Bookmap has been an unbelievable partner in helping us develop this algorithm. Obviously, Bookmap is a unbelievable technology provider. Their charts work beautifully with dozens of indicators overlined on them. It works seamlessly and beautifully, and they have really helped us to wrangle this giant data feed. We have a black box that sits inside the Bookmap infrastructure, and this is all designed with speed in mind. We don't want to slow down your charts. We know that the flow of information, and you don't want to have any pixelation or pauses or stutters in your data. And so we've built this in mind, and it works very fluidly. So again, just to talk about HIRO, HIRO is the hedging impact of real-time options, and we are not measuring the options volume. We are measuring the hedging impact, and that's a key differentiation. If 10,000 calls trade at a strike that is extremely far out of the money, the hedging impact of that is probably very little to none, right? But even if just one very large contract in the SPX trades at the money or deep in the money, right, that could have a major impact on the markets. So the differentiation here is important. We have a proprietary algo that is measuring the hedging flow, and we are not simply looking at volume. So let's look at what you have here with the HIRO indicator. On chart, on the top here are two series of triangles. They are red and green triangles. Each of those triangles represents an options trade that has just taken place. A green triangle indicates a positive hedge from that trade, meaning the market makers need to buy stock or buy futures. And a red triangle indicates a bearish options trade, meaning market makers will need to sell stock or sell futures to hedge out that trade. Now, there are millions of trades taking place, particularly in the S&P 500. So if you look at the ES futures, you're looking at the total flow in the SPX index as well as SPDR ETF. So you can imagine that there are millions and millions of trades taking place. So we are plotting those out on screen, and you'll notice that in that triangle there is a number, and that number denotes hedging impact. So the larger the number is, the more hedging impact there should be. So you can notice here there's a 3,000, a 2,000 number where I'm trying to highlight here, and then if you look over to the left, there's a bunch of smaller numbers, right? 200, 300. So the 200 and 300 are smaller hedges. Whereas the 3,000, 4,000, 5,000, we've seen 25,000 indicators in the triangle, so you can have some very large trades. Now at the bottom is the rolling summary of all of these triangles. So basically it's the rolling sum of cumulative impact. So what you get from that is you get a great view of one. You can see that it responds, the cumulative indicator responds or shows you a big trade just took place, but you also see the cumulative flow build up over the day. And that rolling basis can be extremely valuable, as we'll show. But on our screen here, we have the bid in red, and the green is the offer. And so you can see that as a big trade takes place, because this cumulative indicator drops, you see the futures price drop about 3 handles, and you see a big print, right? A big futures print takes place, and then the price mean reverts as that hedging flow is gone. So we see setups like this all the time. Some of them have 10, 20 handles of impact. Some have 1, 2, 3 handles of impact, right? It depends on how big that trade is and how the dealers are choosing to hedge that trade. Now, the on-chart indicators are fully customizable. We have a YouTube video set up to talk about this, so I don't want to spend time on that now, but just know you can do all sorts of things to change the aggregation or color, etc., of those on-screen triangles, but you cannot adjust this cumulative indicator. The cumulative indicator will pick up everything from a one-lot trading all the way up to whatever the largest trade is on the day. Okay, so let's talk about some quick examples. This is GameStop on your screen here. Now you can see GameStop is around 167 a share, and it builds up into 170, and the stock is at the highs for the day when all of a sudden you see this bearish options flow come into the market. You know it's bearish because obviously the indicator is going down, but on screen there are some really large numbers popping up. And the response from the stock off of the highs is a very sharp sell-off. And this again is likely because either traders are selling calls or buying puts, and the hedging flow to hedge out that risk is to sell GameStop stock. And so we think that there is an absolute correlation here. I mean, it's an undeniable mark that this is the top for the stock, the hedging flow comes in and the stock reverts about $3. Now you also notice that it's around this point that the HIRO indicator flattens out. And when that flattens out, that's telling you that the options flow has settled down or stopped, right? And that is in and of itself a signal. You have bearish flow coming into the market, the stock sells off, and then that flow subsides. So is this a bottoming point? Is this an area of inflection, right? There's all sorts of different indicators you can imagine you can pull out of the fact that this is tapering off after large selling. And we have some other examples of this. But the key here is to note that there is just undeniable timing between these large flows coming into market and the way the stock trades lower. Here's a very interesting way to view this. We actually are able to monitor the VIX Index Options. So if you look at the VIX Futures, you will get the VIX Index Options feed. And in this case, we saw massive call buying in the VIX at this point. And that VIX call buying continued throughout the afternoon. And you can see with that, the VIX Futures caught a bid and started to pick up into the end of the day. Now, the link between the VIX Index and the VIX Futures is a little more spurious, right? It's not quite as direct. But the fact that you can monitor the real-time flow of the VIX Index is a powerful indicator for anyone trading, Nasdaq Futures, ES Futures, even single stocks. You want to know if big flows are coming into or out of the VIX. It's very important, right? And so this is another great way to use the indicator. You can see how clear as day it is that these big flows are coming in. I'm sure many of you remember the famous trader 50 Cent, right? This is the guy who every month after month was buying giant VIX calls. Well, that's going to show up in your indicator here, and you are going to know how impactful those trades are, right? Because we're not just telling you it's volume. We're telling you what the hedging flows of those VIX trades are. One of the other things that we wanted to talk about and mention here, our good friend Bruce at Bookmap provided this chart, and you can see that this is the Nasdaq Futures, and the key here is that where you see these large triangles are also spots where there are icebergs and stop runs that show up. So not only do you see on the screen the big options prints, but you can see that there are icebergs and stop runs taking place. And as a trader, having that information and understanding why is there a stop run, right? What were these iceberg orders? Well, if it coincides with a big options print, you have a whole bunch of information, right? Just like if a piece of news comes out, why did the market just move 10 handles? Well, news, headline hit the tape, right? Oftentimes you may see a big move in the market and you don't know what took place. But now you can see, oh, look, big options print. That's why the market just traded up or down 5 or 10 handles. And now that I know that was just an options print and hedging flow, I can react to that differently, right? Than if it was a headline about interest rates or the Fed, QE getting cut or something like that. So the coincidental indicators here are very strong, and when these things all combine, we think it really makes the signal all the more powerful. So here are some more examples just to show you that we've seen. This is the ES Futures. You can see here that this is right around the options flow starts to sell off, and with that the market comes down, and then there are some very large call trades that take place off the bottom here, and with that the futures move up 20 handles. And we'd also note that the futures move up directly into the SpotGamma indicators that we provide on chart now. So a lot of people ask us, is the HIRO meant to replace SpotGamma, signals and indicators? And the answer to that is absolutely not, right? These two things work together. With SpotGamma, we're going to tell you how much volatility we expect in the day, and we kind of lay out where the big indicator, big levels are, right? But how do you know whether there's bullish or bearish pressure? How are we good at assessing whether we're going to test higher levels or lower levels? Well, this is something that the HIRO indicator is filling in sort of during the day. And we can also say that if big bullish flow is coming into the market all day, that's likely to add gamma for tomorrow, and that may lower volatility for tomorrow. Just like conversely, if big put flow comes in, we can expect that tomorrow now may be more volatile because of that, right? So HIRO is filling in some of the gaps around, the intraday gap, I would call it, between the daily SpotGamma updates. Here's an example of the cumulative flow over the day. So you can see that from the start of the day, really all day, there was just very bullish flow in the ES again. And with that, every dip gets bought in this case. All day long, the dips are bought. There's a lot of mean reversion here. But what we really like to highlight is the market pulls up into this big 41.85 area. And then you'll note this is right around the market close right here. So you have this bullish flow. We talked about how market makers may need to hedge into the close, right, to address their risk. So if they had bullish flow added, to their books, call buying added to their books all day long, it's likely that they need to buy a bunch of futures to hedge themselves out. And that flow will manifest at 3:30, right, 30 minutes before the close, 15 minutes before the close. And we think that there's a correlation here between this bullish flow throughout the day and this major pop, right, 7-8 handle pop into the close to finish out some of their hedging. We're working on gathering statistics around this. So you can see there is a cumulative indicator here that's telling us the amount of flow on the day, what our proprietary indicator is measuring. We've seen that number as high as 900,000 positive, as low as minus 600,000 negative. And over the next several weeks, we're gathering statistics so that we can tell you, look, when the HIRO indicator is up 500,000, that means stocks are going to do X, Y, or Z, right? We're working through regressions and we're drawing correlations, and we're going to be providing that data over the next several weeks so that you can make some better trading judgments off of this flow. It works the other way around. This is, again, the ES, and you can see that this was a fairly weak day, right? And then around where this yellow arrow is, there was actually a Fed headline. It was around 2 p.m. Data release. And so the market reacted negatively to that data release. You could see it sold off here. But what was interesting is the put flow was coming into the market, not in a major way, but it was leaning on the market. And then at that same time, at 2 o'clock, the put flow really picked up strongly. And a lot of times after these headline releases, you would expect a bounce in the market, right? The initial, the news algos read the headline, they sell off, and that price will obviously sometimes mean revert. But what was different here is that the put flow never backed off. Once that put flow came into the market, it was unrelenting. It did not back off. The put flow did not cease, and it just kept accumulating. And with that, there was no bounce really in markets. We saw that pressure all the way into the close, and then you could see even after hours into the 4:30 time frame, we really closed lower directly on this kind of put wall level. So a coincidental indicator, we call it, that the put flow here was backing up this idea that you may not want to try to buy the dip, right? Because the put flow or the option flow is suggesting, that dealers need to sell more futures and sell more stock. Now, if you're interested in getting the HIRO indicator, I'm going to show some of the real-time charts. If you're interested in getting the HIRO indicator, it is available now at Bookmap, the Bookmap URL on your screen. If you just go to the Bookmap Marketplace, you can just Google that, and you can hit add to your cart. It's $79 right now until the end of the month, and then we are going to raise the price on that on June 1st. So you're able to lock in that $79 per month right now. It does not matter what stock or futures data feed you have. You can use Rhythmic, DX feed, IB, Interactive Brokers, Link, whatever it is, that's fine. The HIRO indicator itself is self-contained, meaning the data is self-contained. So that $79 a month for the HIRO indicator is all you need, in addition, obviously, to your sort of Bookmap subscription. So with that being said, I want to bring up the Bookmap system here and look at some of the real-time flows that are taking place. With what we're seeing today in markets, we put out, our volatility view this morning that the volatility should be lower because gamma is building higher. So as our overall measure of market gamma builds up, volatility should come down. And that is because of the dealer flows that we think kind of suppress volatility. Now, what you can see here is that it's a very tight range in Nasdaq, and it's consolidating under what's called this combo level. And this combo level is the combined Nasdaq and QQQ options flow. And you can see how that has kept a lid on things, so to speak, right at this line. And what's interesting also about that is you can see these chunks of put flow come in, and with this these chunks of put flow come in, volatility comes in as well. So off of this big combo level, we saw some big put orders come in, and with that, the market comes down, right? And then after that order is done, we've really seen very flat flow throughout the rest of the day, meaning not really bullish or bearish. It's just a very quiet market, and the market recovered sort of from that initial drop, and now it's just trending sideways, kind of grinding right under this big combo level. So we're checking off this box of low volatility, not a whole lot of put flow or options flow, but the options flow that did manifest was bearish, and you can see the market moves lower at the same time. Now, what's kind of interesting and cool about what you can do with Bookmap is you can really zoom in here and you can get a lot of granularity into what is actually taking place. So, if I scroll my mouse wheel here, I can actually see, where the trade that took place, and then obviously how the flow reacted with that, right? So you can really zoom in exactly and see, okay, here are two big options trades, right? The cumulative indicator comes down and the flow seems to pick up, right? There's some reactions. Now, this is a small trade, but you can see there appears to be a corresponding reaction to this. And this actually raises a good point about how some flow comes into the market. A lot of the big flow, if you're a big fund and you want to trade a sizable order, you're going to call a bank desk, right? You're going to call JP Morgan or Goldman Sachs, and you're going to say, I want to buy 10,000 calls. And they're going to give you a price on that, and they need to put that trade up with a hedge usually. And oftentimes they will print the hedge first before they print the options order. So a lot of times you'll see big options trade take place, but you'll see the movement before the actual trade ticks off. Now conversely, if it's like an algorithmic sweep order, where a trader uses a strategy, a sweep order, where they hit all the exchanges at once, this is often a equities type trade. I want to buy Tesla calls. I'm going to use this algo to go out and hit all the 12 or 17 exchanges, I guess now we have in the U.S. options market. The market makers can't get in front of that order, right? Because they won't know until the order swept all the markets what's happened. So the market making flow, the hedging flow will come in after that sweep order is done. So a lot of times the hedging flow will be, again, before or after, but you will see that it'll take place kind of right around where these bigger prints take place. Looking at the ES, it's kind of a similar situation today. The top is right at this big combo level. The bottom obviously is 4,200. But what we're seeing now is this is not particularly bearish flow. Again, we've seen numbers as low as negative 600,000, but it's very clear what's taking place here, right? You'll notice that there's this kind of big drop in the middle of the day, and there's this weird crescendo of flow. It looks like maybe a straddle or something traded where there's this apex of a bullish options print, and then after that bullish options print, it's been fairly consistent bearish pressure here, which is interesting, because we're above 4,200, which is a positive gamma level, but this is leaning on the market. Again, it's not a humongous, overly large amount of flow, because this is negative 20,000 versus, say, a negative 300,000 is what we've seen. But this is not the type of bullish flow that you would want to see if you were looking for a big breakout into the afternoon. So that's something to kind of keep an eye on here if this pressure is really going to build throughout the day, throughout the afternoon. Flipping over to some of the single stocks, which are always very interesting to look at, which you'll see more with single stocks. So in futures, we think that the cumulative indicator is a little bit more powerful, right? Because to move the S&P 500, you need a really, really big order. And as you start to look at some of the different single stocks, smaller orders can have a much larger impact. Now, Tesla is a very big stock, obviously, in terms of market cap, very active options position. But you can see that in this case, we had bullish flow kind of really from the jump to start the day. And with that, the stock really punched higher, right? It had just very, bullish start to the day. And what is interesting about that here is we show that the largest amount of gamma for Tesla is at the 600 strike. And so we think that if you zoom out a little bit, right, over the next 2 days, that there's bearish pressure. This would be kind of a charm-based trade for those of you who are familiar with that concept, where the options are decaying, and that means that hedging flow is going to pull the market back down to that 600 strike. What I see on my chart here, though, is that we had bullish flow from the start of the day, and then you'll notice that it just flattens out, right? So the stock was up along with that bullish flow, bullish options flow, but then the flow kind of the spigot turned off. So no one's trying to short Tesla, but no one's trying to buy it anymore either. So you can see that that bullish, kind of tailwind really tailed off here as this flattens out. And with that, the stock did just drift lower because the options market has basically now stepped aside from this thing on an intraday basis. But we still have this big 600, magnet, right, that might be working into Friday's close. You see a similar thing here in GameStop, where it's the same idea. Bullish flow again to start the day, which is interesting because a lot of these smaller, obviously GameStop's trading at $200, $230, but all these meme stocks, these popular, retail names, you see this bullish flow to start the day today, and then it just tailed off, right? People are getting tired. I guess they want to go outside and enjoy the nice day. And with that, the flow is kind of consolidating here. And, GameStop, I think, has 50% of its gamma expiring on Friday. Call options are very expensive right now. I think that's going to, just like Tesla, kind of start weighing on that stock. And that bullish flow is really tapped out now, right? If retail was still really interested in trying to pump this thing higher, you would see the cumulative graph just kind of accelerating to the upside. But what we have here instead is the flow is tailing off, right? People are getting tired and that flow is drifting away. Last one, then I'll take some questions. Right, it's a similar thing, right? What we're seeing here is bullish flow to start the day, right? And that breaks out. And then the bullish flow tails off, it tapers off. And with that, you see this drift down lower. So options players aren't shorting this name, but when you had this bullish runs where options came in, you have high volatility. That volatility starts to burn off. A bunch of gamma is expiring tomorrow, and that starts to really weigh on the name, right? That bullish flow, if you're looking for a call squeeze, has really started to subside. So with that, I'm going to flip over to the ES. I'm going to try to scroll through some of these questions. I know we have SpotGamma support on here as well. This is actually my co-founder, Matt, is manning the support today. Thank you, Matt, for doing that, as we have our support staff on vacation. Julia, who a lot of you all know. So any questions, pop them in here and we will. Yes, Mark, I use Unix. How can anyone trade on the indicator? So it's a great example, Alex. Number one is, we hopefully we've already answered this question for you, but one, the cumulative indicator is going to tell us a bullish or bearish stance on the day. Think of the cumulative indicator as a hedging pressure. So one, you can identify quickly large sets of trades, right? There's multiple trades taking place here that are bearish. This is adding pressure to the market. So that is one indication. And then two, you can see where there's a sharp drop. We know there was a big trade that took place. You can see there's a 17K triangle on the on-screen indicator here. And I can zoom in and see the flow that actually took place around this. We've also seen that when there's a big sweep order in single stocks that you can play with that GameStop example, big put trade comes in and the hedging flow needs to address or hedge out that trade, and you can decide to either jump on board that trade or wait for that flow to die off and then play the mean reversion, right? So there's a bunch of different ways you could structure trades around these kinds of things. Where can you find a list of stocks? Helio, we have a page. I believe our support manager has entered in on that. There is a list available. We will post that in the chat, and as well as on the we'll be sending out emails, to help lay that out. Travis, hopefully I addressed your question in regards to the feed. You for HIRO, you do not need a specific data feed. You can use any data feed you like. JR does work on the daily chart. Hopefully being able to see that. Okay, there's some bundle questions. I think we'll all getting in that. Barry, good question in regards to the historical data. I think we're hopefully only a week or two out from that, right? This ties into gathering some of the stats as well, to make sure that we are gathering all the information and building out the historical data. All that is kind of tied together as sort of the level 2 product, so to speak. So. All right, with that, I want to let you all get back to your trading, and we hope that this was helpful. We hope that you're able to see kind of the power of the indicator. It is a month-to-month subscription, and we are here at info@spotgamma.com to answer any questions. You can also go to support.spotgamma.com, and you can type questions in our support search, and we have a whole bunch of articles and examples related to this, as well as other videos on our YouTube stream. So we very much appreciate your time here again, and we hope to hear from you soon in regards to the HIRO Indicator and any of the other SpotGamma products. So thanks, everybody. Appreciate it.